Hi, good afternoon. Welcome. Thank you for joining us for today's webinar, where we'll review some helpful financial steps you may want to take between now and the end of the year. I'm Lisette Smith. I'm a senior advisor here at the advisory group in our personal wealth group.
And I'm Margaret Hiller, and I'm also a senior advisor. I serve both our personal wealth clients and our institutional clients.
And we tried to make our webinar today as concise as possible, but we actually have 15 topics to touch on. Some of them have some complexity. So please ask any questions in the chat box as we go on. And if we don't cover them in the presentation, we'll answer them at the end. Or if you have questions that are specific to your situation, please just follow up with us afterward with a call or an email, and we'll check in then.
So today we're going to be discussing financial steps that you may wish to take before the end of the year. There are things that you may want to consider spanning various areas, including retirement planning, income tax planning, some investment strategies, and of course, charitable giving and annual giving. Also, now that we're into December, hard to believe, it's important to keep in mind a few important dates to remember, especially since some of them are just around the corner.
So one of the most common year-end to-do items is to make sure that you've taken any required minimum distribution from your retirement accounts. So beginning at age 72, you need to start withdrawing funds from your tax-deferred accounts, except Roth IRAs. The amount to be distributed is calculated based on the market value at the end of 2021. For our clients, we have already or will contact you soon to determine how you want your required minimum distribution to be distributed to you and how much tax you want withheld. If you turned 72 just this year, just in 2022, you technically have until April 1st of 2023 to take the distribution, but we usually don't recommend that because then you have to take 2 distributions in 1 year, and that increases your tax bracket and income-related adjustments to Medicare. But even if you're not yet age 72, you may have a required distribution from an IRA that you inherited. So you should be aware that the rules on inherited IRAs changed this year, so you'll need a new calculation. Also, I just said that there was no required distribution from a Roth IRA, but if you inherited one from someone other than your spouse, there is a requirement. It may not be a taxable withdrawal if the original account was held more than 5 years. But this is on the top of the list because if you miss your required minimum distribution, the penalties are steep. The IRS takes 50% of the amount that should have been distributed to you. One strategy that's become more popular to use for your RMD is to make charitable contributions. So that's the next item here, qualified charitable distributions. And what a QCD does is allows you to take your RMD, which would be taxable income to you, and donate it directly to a charity. And then the amount that's donated is excluded from taxable income. One of the reasons this is becoming preferable is that with the higher standard deduction and deduction limitations, many people no longer itemize their deductions, so you can't just take your other charitable contributions on your Schedule A, which you used to do. So this is a way to exclude your contributions from your income, and it can also help for the taxability of Social Security and Medicare surcharges. QCDs, even though they're related to your RMD, they are allowed beginning at age 70 and a half. So if you're taking regular distributions earlier than 72, you could still use a QCD to offset that taxable income if you're over 70 and a half. The annual limit is $100,000. And then there's some other stipulations if you're still contributing to an IRA. But generally, people have been finding this more attractive.
Another strategy you might consider between now and the end of the year is a Roth conversion. This is also gaining a lot of popularity. So for those of you that haven't done that before, this is where you take your pre-tax IRA balances and convert them to Roth after-tax balances. So the advantage of this strategy is that all of the future earnings on the Roth balances will be tax-free, provided that you satisfy the requirements for what's called a qualified distribution from the Roth account. It's also possible to execute a conversion such as that within your employer's 401k plan if the employer offers Roth 401k and if it allows for in-plan conversions, which many do. One note is that the required minimum distribution rules that Lisette just mentioned are different for a Roth IRA than they are for Roth 401k balances. So Roth IRAs are not subject to RMDs, but Roth 401ks are. So if you're approaching RMD age, it may be to your advantage to execute this transaction inside of an IRA rather than your 401k plan, or as part of a distribution from the 401k. So Roth conversions make a lot of sense, particularly in years in which you have very low income, when you're in a lower than usual tax bracket, and also in years in which your portfolio value is down, which for many people is this year. So this is a strategy to keep in mind. But do be aware that when you have a Roth conversion, that is a taxable event if you're using tax deferred money to convert. And the taxes are due from outside of the account. So you'll want to be sure to plan for the associated taxes. So a Roth conversion is a good backdoor strategy for people who have been interested in building Roth balances, but have not been able to make contributions directly into a Roth IRA. Many people are prevented from doing that based on their income levels. So what we've described just now is a Roth conversion of pre-tax balances. It's also possible to make a non-deductible contribution to your IRA, which is after tax, and convert that to a Roth. The nice thing about that is that there's little or no tax impact at the time of the conversion. The thing to watch out for there is that there are some rules. If you've been taking other distributions from that after-tax account, you have to be careful not to run afoul of some rules that look at all of your IRAs together, et cetera. So if you do this with a pre-tax account, it's pretty straightforward as long as you're careful to make arrangements for the tax payments. If you do it with non-deductible contributions, you have a few more rules to be aware of. There's another strategy that's probably lesser known, which is called the mega backdoor Roth conversion. This may be available to you if you're still working and if your employer's plan provides for both a Roth 401k and a traditional after-tax employee contribution. That's a little less common. There are many plans that allow for Roth 401k, but not as many plans that allow for traditional after-tax contributions. So Roth 401k and traditional 401k are both subject to an annual contribution limit. This year, that limit is $20,500. It's increasing because we've had such high inflation recently. The limit's gone up by $2,000. So next year, it'll be $22,500. Plus, there's a catch-up if you are over age 50. However, so that's the Roth and the pre-tax 401k. However, with traditional after-tax contributions, those types of contributions are not subject to that same annual limit. Instead, after-tax contributions are subject to a different limit, which is based on total contributions, employee plus employer, into the plan. So in 2022, in the current year, that overall limit is $61,000, and next year that's going up to $66,000. So let's say that you contribute $20,000 out of your paycheck into the 401k portion of your plan. And let's say that your employer contributes a $10,000 match. So $30,000 has gone in between the two of you. This leaves room for you to make an after-tax contribution of more than $30,000 in addition to the 401k that you have put in. Because that limit is over $60,000, you could put in another 30. You could then immediately convert that balance to Roth. And since that contribution was funded with after-tax dollars, there's no tax due at the time of that transaction, assuming that you do it right away and don't have any earnings on that balance yet. Now, again, this strategy only works if your employer's plan offers those traditional after-tax contributions, but it's a way for you to load up your retirement account with Roth money. And if your plan does not offer that option, not to worry, you can still do a Roth conversion, as we described, a few minutes ago, converting your existing pre-tax balances to Roth, but you just need to keep in mind that that will be a taxable event and there will be taxes due.
And Margaret just went over some of those limits, but just to review them in more detail, because we really recommend that you contribute to your 401k and retirement plans to the allowable limits. So for 2022, for 401ks and 403b plans, your elective deferral, as Margaret mentioned, was $20,500 plus catch-up provisions for those over 50. It was an additional $6,500. For 2023, that is going to be $22,500 plus an additional $7,500. So next year you'll be able, if you're over 50, you will be able to put in a total of $30,000 into your 401k or 403b plan. And remember, if you are turning 50 next year, you can kind of begin your contributions at the $30,000 annual rate from the beginning of the year, just to make sure that you do max it out. You can always catch up at the end, but it's if you want to do it over the course of the year, you can start right at the beginning. You don't have to wait till you actually turn 50, as long as you'll be 50 by the end of the year. So again, as Margaret mentioned, the total plan contributions, including your employer matches and your profit sharing contributions, are $61,000 this year and $66,000 next year. So that's going up quite a bit. And that doesn't include the catch-up provisions if you're over 50. So you can add the catch-up provisions to that. Not on this list are IRA and Roth contributions limits, which are subject to income limits. And those this year were $6,000 and or $7,000 for people over 50. And next year they're just going up by $500. So $6,500 would be the limit, or $7,000 over age 50. So just be aware to set your contribution limits for 2023 and take those increased limits into account so that you can fully contribute.
So the next area is income tax planning. So first, talking about funding your tax liability. So there are rules about how much you need to pay in during the year to fund your income tax liability. And if you underfund, you may be subject to an underpayment penalty. So it's very important to pay attention to this requirement. In order to satisfy the IRS's safe harbor for funding, you have to have paid in either 110% of your prior year's tax liability if your income, your adjusted gross income, is over 150,000, or 100% of the current year's liability. And those numbers are reduced to 100% of last year's and 90% of this year's if your income is under 150,000. So if you discover late in the year, so for example, if you were to discover now that you have funded less than what's required for the year, it can be remedied in one of two ways that could work to your advantage. So one is that you could increase your tax withholding through payroll if you're still working, or you could take an IRA withdrawal and put a portion of that, or perhaps all of that, to federal and or state withholding. These amounts, whether you submit them via payroll withholding or withholding out of an IRA distribution, are treated as though they had been withheld and submitted ratably throughout the year, even if you're taking them at the very end of the year. So if you take an IRA distribution on December 30th and make it all federal tax withholding, it will be reported to the government as though it was withheld ratably throughout the year, which is important because not only do they have rules about how much you put in for the year, they also have rules about what percentage you have to put in at various points throughout the year. So this is a way to catch up late in the year if you're behind on the percentages throughout the year. So if you're using the current year method, instead of relying on last year's income number, it's a little bit of a moving target because sometimes you don't know what your income is going to be, or you don't know what your capital gains distributions might look like. So this gives you a last minute way to resolve any shortfall. You just want to be sure that you actually make this either payroll withholding or IRA distribution withholding, that you do that by the last day of the year. And the current year method is very helpful if you had an unusually high income year in the prior year and this year is a lower or a more typical income year. That might be a reason for you to rely on the current year method, even though it's a little bit of a moving target. Another strategy that we employ with regard to income tax planning is tax loss harvesting in taxable investment accounts. So this is a strategy where we sell positions that have sustained paper losses. So if the market is down and the funds are down for the year, and then we replace them with a different position that is in the same asset class. So this allows us to bank the losses for tax purposes, but still remain fully invested in the same asset class so that you catch the eventual recovery in that asset class when the market comes back. When you do this, one has to be mindful of what's called the wash sale rule, which if you violate that rule results in a disallowed loss. So the wash sale rule says that you cannot buy a security within 30 days of selling it at a loss. And that purchase looks both 30 days prior to the sale and 30 days after the sale. And it also requires that you use a substitute security that is not substantially identical to the one that you sold. So for example, you could not sell the Vanguard S&P 500 index fund and replace it on the same day with the Fidelity S&P 500 index fund because those would be considered substantially identical investments. So one can get more sophisticated on the whole concept of tax loss harvesting by not only looking at the overall holding and whether it's had a gain or a loss in aggregate, but looking through to the individual tax lots. So if you've been investing over time into a fund and you've had multiple purchases over the years, you have multiple tax lots. And when you are thinking about tax loss harvesting, you can look through and find the tax lots that have had losses and swap those out into substitute securities to realize those losses. So why is this good? So you bank these losses, and these losses can be used to offset realized gains. And those may be gains that you realized earlier in the year, and so you're bringing down your realized gain throughout the year if you then have tax loss harvesting, or they can be gains that you realize after the fact, or they can be gains that you bank. So the first $3,000 of realized losses can be used to offset your ordinary income. And then any additional losses can be carried forward indefinitely to be used against future realized gains. So if this strategy is of interest to you, there's a blog post on our website that goes into more details. And I know we have some people on our call today who are current clients and others that are just listening in out of interest. If you're a current client, this is something we're already doing for you. But if this is something that we're not managing your portfolio, or you have outside assets, or you're not working with us, you can read more about it on the blog post to understand how it works.
And the last item under income tax planning is just for California residences, but it's an important one, so we wanted to mention it here. For business owners, if you are in a pass-through entity, California passed legislation in 2020 to get around the new $10,000 deduction limit for state and local income taxes. So that's called the SALT rules. And that was instituted in 2017. And prior to that law, you could fully deduct state taxes from your federal taxes, which for California residents can be a significant amount, since the highest state marginal tax rate is 13.3%. So instead, now those it's limited to $10,000 combined, your state and your real estate, your property taxes as well. So now, though, California allows owners in a pass-through entity, so a sole proprietorship, partnership, LLC, S Corp, to elect to pay 9.3% of their California state taxes, income taxes, through the entity. And that way you get a federal deduction for the amount paid in, the full amount paid in. You need to do this for the whole year, though. So if you didn't already transition to this method in 2022, you can start in 2023. So for example, someone earning $400,000, this allows $37,200 to be deducted through your company, rather than having your state tax deduction limited to $10,000 if you paid it on your individual tax return. So it's really a significant benefit for business owners who are in smaller companies or pass-through entities. When it comes to income tax planning, we just want to remind you that as CFP professionals, we do some specific tax analysis as part of our financial planning. But what we're giving here is general tax advice and information. So we're not CPAs. You should consult your tax preparer for more specific information to your situation. But we can help with the general topics and bringing things to your attention.
So next we turn to investment strategies. So we use tax-sensitive trading strategies throughout the year. You may be familiar, we talked a few minutes ago about tax lots. So you may be familiar with tax lot selection methods, such as first in, first out, last in, first out. We call those FIFO and LIFO, or perhaps average cost, which is a common one that the custodians tend to default your account to. You have a general retail account at various providers. Our trading platform allows us to basically optimize the tax lot selection beyond those traditional methodologies. So we call our method tax optimization. And in the tax optimization method, the way that it works is that first we sell the tax lots that have short-term losses, and then we sell those with long-term losses. And that next we sell those that have long-term gains, and then lastly we sell those that have short-term gains. Using this method, or this ordering of lot selection, allows us to minimize the realized gains that we generate as we're rebalancing your portfolio over time. So if you have outside accounts that we don't manage, it is possible for you to do this on your own, for sure. It just requires that you manually select the lots, because if your custodian does not support that particular lot selection method, and many do not, there's some custodians that you go, they just offer you first in, first out, last in, first out, highest in, first out, or average cost. then the only way to do this yourself would be to use a method where you specify and manually select the lots every time that you trade. And another note here on investment strategies is that as we get close to the end of the calendar year, if you have new funds to invest, new cash to invest, it's a good idea to pay attention to when the mutual funds are going to be paying their capital gains distributions for the year. So mutual funds are required to pay out short and long-term capital gains that they realize throughout the year. They pay those out to their investors. And you want to postpone your new investment until after those capital gains are distributed. And the reason is, for example, if you make a purchase of $10,000 into a fund, and then 3 days later it pays out a capital gain distribution of $2,000, you basically just got back $2,000 of the 10 that you invested, and you got taxed on it. So it's to your advantage to wait until after the capital gain distribution is paid before you make that investment.
So the next category we'll discuss is charitable giving. Since the end of the year is when a lot of people make their charitable donations. And first, when it comes to charitable giving, there really is a benefit to giving appreciated financial assets like stocks and mutual funds rather than cash to a charity. It's very easy to do. Almost all charities accept stock donations now. And the reason it's beneficial is it allows both you and the charity to avoid capital gains on assets that have increased in value. So instead of selling a stock, paying taxes on the gains, and then donating the proceeds, if you donate the stock directly to the charity can sell it. And since they're a tax-free entity, they do not owe any tax on that. So the full market value of the shares is received by them, and the full market value is also able to be deducted by you, not diluted by any tax. I think, sometimes people are reluctant to do that because it feels like it's complicated, but really it's only marginally more complicated than writing a check. The next item is also something that's become more prevalent in the last few years because of the tax law changes we mentioned earlier. So the donor advised funds allows you to set up a fund at Schwab, for example, or other custodians have them as well, and donate appreciated shares and get the tax deduction in the current year. Although you can send the donations to the charities over time, over several years, really, for example. So what this does is it helps you to bunch up several years of giving into the tax deduction for 1 year. So you get the full deduction now, put it in the fund, and then you can kind of grant those funds over time. And it's helpful to do it this way, again, because of the increase in the standard deduction and the limits on state and local taxes. So fewer people benefit from itemizing now, which you would have to do to take the charitable deduction. But this way makes itemizing more appealing, and so makes the charitable deduction worthwhile because it can be higher to support ongoing contributions. There are some other benefits to a donor advised fund. For example, if you want to donate this year, but you just don't have time to figure out how to grant those funds to the charities you're thinking of by the end of the year, it just gives you more time to do that. So you can make the donation and then kind of take your time and talk to the charities and plan your giving. There is also an option if you're going to do it over a longer period of time, do your grants over a longer period of time, these funds can be invested as they're awaiting a charitable donation for the charities you want to give to. Another benefit is that the donor advised funds accept private equity shares or restricted securities. It's a little broader about what can be donated and then sold through the donor advised fund and used for charitable giving. So that can be a benefit for less liquid assets. Some families also use donor advised funds as a way to set up and discuss kind of family legacy giving and the charitable priorities for their grants. There is still time to set up a fund and fund a donor advised fund for 2022, but you would need to do that soon, probably within the next week or so.
All right, the next subject is annual giving. So if you've not already done so this year, this is a good time to consider making gifts to family members. So the annual gift limit for the current year is $16,000. And if there are two spouses, each spouse can gift up to that limit to each child. You may want to consider gifting appreciated securities rather than cash. I know that it's very common for people to make cash gifts to their family members, but there may be an advantage depending on your income tax bracket and your child's tax bracket. There may be an advantage to gifting appreciated securities. So keep in mind that when you gift appreciated securities, for example, to your child, you don't get the step up in basis that you would if it were a bequest, for example. And there's no exclusion on the gain that, as Lisette just described, that would happen with a charitable donation. But the idea here is that the recipient of the gift ultimately pays the tax on the appreciation, but they may be in a lower tax bracket and often are in a lower tax bracket than the person who's making the gift to them. So this could be a good strategy. If you are in a high tax bracket, your child's in an unusually low tax bracket or much lower than yours, you can donate appreciated shares when, or sorry, not donate, gift appreciated shares, and then when they sell the shares, then they're responsible for the tax, and you can always gift the amount of the tax to them as well if you'd like to square them up. If you decide to employ this strategy, it's important to keep in mind that if your child is under age 18, or if they're a full-time student and under age 24, the assets may be subject to the kiddie tax rules that you may be familiar with. So this strategy works best for adult children who are no longer covered by the kiddie tax rules, and particularly if there's a big disparity in income tax rates. Another area to consider is 529 accounts for college savings. You can make gifts to your children or to your grandchildren into their 529 accounts. And these again are subject to the gift rules. You are permitted to front load, or what some would call super fund, a 529 account and fund 5 years in advance all at once. So for example, this year, since the gift limit is $16,000, you could contribute up to $80,000 into a child or a grandchild's 529, or if they're two spouses, you could do up to $160,000 to that single lucky grandchild if they're two spouses that are making the gifts. So one note about front loading 5 years worth of gifts into a 529 account is that you do have to file a gift tax return when you do this. There's no tax due at that time, but there is a little bit of complexity in terms of your tax filing. So you have to consider the cost of the additional preparation and additional complexity to your tax reporting.
So we've kind of piled a fair amount onto you, and some of these things may not apply, and some do. But we did want to provide some deadlines that are coming up. So just one of the things we didn't mention is that next week, December 7th, is the deadline for Medicare open enrollment. So if any of you are on Medicare and anything has changed for you, like your prescription medications for the year, you may want to take a look at changing your coverage, and you can start at medicare.gov to review that. You have about a week to do that. You also have a little over a week to decide if you'd like to set up a donor advised fund for the year, just to make sure that we have time to set it up and fund it by the end of the year. And you also have until next Friday, the 9th, to have your instructions into your custodian for your required minimum distribution or qualified charitable distribution. As I said, we have contacted most of our clients about this, or will shortly. And I know the deadlines seem early because you have till the end of the year to actually do it, but in order to just make sure they are processed by the end of the year, we really recommend getting the instructions in, and because processing can be delayed a little bit at this time of year. And then, as Margaret mentioned earlier, you have until just before your final payroll date to change your withholdings in order to make sure that you have made all of your safe harbor tax contributions for the year, so that you can avoid an underpayment penalty for the year.
Everything we've talked about up until now are things to consider before the end of this calendar year, which is now only a month away. But there are some things that you can wait to do until early next year. So one is, if you are a participant in a 401k plan, and if you are contributing to the limit, you will want to go in and update your 401k contribution rates to take advantage of these new higher limits. So the base 401k limit went up by 2,000, and the catch-up limit also went up by 1,000. So if you're putting your contributions in throughout the year, you'll want to go in. You can do it anytime, but perhaps you'd like to do it early in January so that the increase is made throughout the whole year. Another is that if you are a business owner and you are looking for ways to reduce your tax liability, or are interested in putting in a retirement plan for your employees, you have until your tax filing deadline in 2023 to install a plan for 2022. Now, of course, when you do that, you can't be implementing a 401k plan, because that can only be done prospectively, since 401k deductions come out of employees' paychecks. But you could install and fund a profit sharing plan in 2023, retroactive to 2022. And that way you get the full benefit of the deduction on that contribution. So some business owners may want to wait and see what their tax liability looks like it's going to be, and then make a decision about whether to retroactively install a plan. In the past, plans had to be in place by the last day of the year. So in the old days, which were just a few years ago, you would have to decide by December 31st if you wanted to put in a plan for that year. But those rules have recently liberalized, and now you have until your tax filing deadline. Roth contribution. So if you would like to make a contribution directly into a Roth IRA, you have up until April 18th to do so. And that can be designated as a contribution for 2022. It may be wise to wait until sometime around then to make the contribution, because you'll want to look at your tax return first and make sure that you're going to be under the compensation cap before you make a Roth IRA contribution. If you fund it and then discover later that you've gone over, your compensation is too high, there is a way to back that out, but it's easier really to know your compensation first and then make the contribution. And lastly, if you make contributions to health savings accounts, so HSAs, you have up until April 18th to fund that account for 2022.
So I think those were really the highlights that we wanted to discuss with you, and just make sure that you were on your radar for the end of the year. Margaret and I want to thank you for joining us today. If you have any unanswered questions, please contact us as soon as possible, and we will take a look at your specific situation and your year-end planning, or just your overall financial planning. We really appreciate your time and look forward to talking to you soon.